This is a Crypto Legends podcast.
Hi, I'm Adam, founder and CEO of Fiat Republic, and I'm bringing you a brand new episode of Crypto Legends. Following the success of our Crypto Legends live panels, which you can check out on our YouTube channel, we changed the format of the show for season 2 to be panel discussions. As always, we want to bring you the best insights from industry leaders on everything Web 2.5 and Web 3. Today, we're discussing fundraising firsts, how to lead raises during crypto winters, with Kevin de Patoul, CEO of Keyrock, Michael Stroev, CEO of Nebeus, and Anil Hansjee, GP of Fabric Ventures. We will specifically cover fundraising during crypto winters, how to understand the precedent for successful raises, and lastly, strategies other companies can imitate. Let's jump right into it. Welcome, Kevin, Michael, and Anil. Let's start with our topic for today, fundraising during crypto winters. I've got a couple of talking points. The impact of the crypto winter. There's multiple statistics, confirming reduction in VC activity or VC interest in the space. But one statistic that sort of stood out, this 91% plunge in investments in January of 2023. And then, to a large extent, the FTX collapse still has an impact or continues to have an impact on the sentiments within the VC community. So, Kevin, you guys raised 72 million in Series B. Congratulations to start with. It was from several investors, from Ripple, from Six Fintech Ventures, Middle Game Ventures. You said that you plan to use the funding to invest further in infrastructure development, scalability tools, regulatory licensing across Europe. You just said, before the show that you want to be aggressive, right? And that sort of gives you that funding, gives you that position. What sort of contributed to your success with this raise?
So I think, of course, there's, it's as any raise, it's the result of, the work of everybody involved in the company like day after day. So there's kind of to some extent, an infinity of factors. But I think that for me, the one defining thing is really around the time frame that we consider when we look at the development of the company. And so we founded Keyrock, so myself and two co-founders, 5 years ago now, end of 2017. And from the beginning, we built the company and we made choices not to optimize our growth that next year, but more to, okay, what is the plan that we have, for the next, 5, 10, and further down the road to build eventually one of the largest financial institutions in the world. But that is the long time frame that we take, which means that it creates a lot of resilience in how you build things, which in my view makes you less dependent on hype cycles. Because, if you've been working on AI for 10 years, I take the example of what is very hype now. If you've been working on that for 10 years, you're not dependent on it to be very hype now and a bit less hype in 2 quarters to actually raise funds, because you have a longer time frame in what you build. And so, of course, the buzz that can be there, that there can be around the market, is going to help, right? If you're raising and, there is an additional buzz, it's just, kind of a rising tide, lifts all boats, so to speak. But I think that it's the cherry on the cake, but it's not the cake itself. If what you're building, makes sense on the longer time frame and does not depend on the fluctuation of the markets, to keep, that economical sense on the long term.
Right, and is this to do with also with your business model, which is quite unique? That you were able to command a valuation that I would assume is also quite high, but also the size of the round is indicative of this. Is this the uniqueness of your business model, or perhaps can more standardized or accepted business models in crypto achieve a similar kind of success when it comes to fundraising?
I mean, I'm sure different business models and different things can achieve the same thing, of course, right? But I mean, in our case, I think what helps as well in our business model, I think multiple things. So one, we are we're an infrastructure of the markets. So we're part of the market infrastructure. So of course there are many questions about as to how will digital assets be used, what is going to be the killer use case, the big mainstream app, and so on. All those questions are there and they all create doubt. But no matter what the answer is, those digital assets will require liquidity. So that kind of takes away a lot of uncertainty as to whether our role continues to make sense, because the reason why you digitize an asset is because it is potentially more liquid than a non-digital asset. It is potentially easier to trade. It's easier to exchange value. So our role as part of that infrastructure is somewhat less dependent on the answers to all these questions. Also, in the way that we provide liquidity, we are market neutral in our trading. So definitely, if we were a long only fund, it would be a very different story, right? So clearly, I think that logic of neutrality, of being part of the infrastructure, if you combine that with kind of a long-term perspective that we take on the market, I do believe that it tremendously helped for us to raise that round when we did in October.
Awesome. Yeah, I mean, we here at Public position ourselves in a very similar way. Infrastructure, the sort of the rails, albeit more focused on the sort of TradFi issue, or the issue that the crypto industry has with TradFi. So I can definitely relate to your strategy and vision, Michael. So what did you guys do, or what have you been doing during this sort of crypto winter and the previous ones as well, to overcome the challenges, when it comes to fundraising, right, and access to capital? Can you share some war stories?
Yeah, of course. I mean, obviously, yeah. We know what the market is like right now. We have seen, let's say, less conversations happening with VCs, especially in 2022. So in 2022, we did several convertible loan rounds with angel investors primarily, which has gotten us to where we are today. 2023, we started doing angel rounds on equity. And right now we're actually in the final stages of closing a Seeders equity crowdfunding campaign. I think today we're at 1.4 million, and this is obviously the first start to kickstart our Series A round, for which we hope to raise 10 million approximately.
Got it. So you're basically going for different vehicles as well, and different sort of options for fundraising to sort of not sort of put all the eggs in one basket, which is would be the VC basket, and to allow the company to continue.
Exactly. And right now for this Series A, we obviously hope to raise VC. We're looking for smart money, not just money, but we're actually looking for strategic investors to come on board.
That's very interesting. Thanks for that. So Anil, as an investor, I mean, listening to this, but also with your experience and the position in the market, what do you look for in startup founders and startups during crypto winters? How do you pinpoint the potential to thrive despite challenging market conditions in your position as an investor?
Yeah, some great stories. I mean, they touch on some of the themes, being flexible as to where you get money from, always, trying out different avenues, being just a resilient and secure place that gives investors comfort about what you're doing is here for the long term, as we heard from Kevin. So, I think those are two examples of what I will describe more generically, which is, investors hate unpredictability. So really all the effort is on to reduce this. The kind of deals that we're seeing get closed are those that can, address immediate pain points with validation, or they are deals that, are looking with some, technology tailwinds, like a little further ahead and are more infrastructure focused on bigger trends and are well funded to take that path. And I think the companies need to realize that in order to position themselves, they need to manage that. They need to demonstrate that they can manage that unpredictability. So, the first thing is clearly, have they adjusted, this is now 6-9 months ago, to the market conditions? Did they cut costs? Did they adjust their business models? Did they have a clear understanding and a clear articulation of how the runway that they have left is going to address the kind of challenging market. Obviously, if there are teams where company leaders have been through prior rounds of down rounds, that kind of helps. This is not the first time we're in a down round. VCs will look at kind of burn rates. They'll look at salary levels. They'll look at, did you ramp up so quickly on your hiring last year in a bull market run? They'll look at sort of how you've thought about, your visibility of your monetization if you don't have that clearly demonstrable today and how that can scale. And they'll try and get validation around as many more of these points, so versus perhaps, in a bull market, investing a little bit in a vacuum on direction of travel. I won't say FOMO, but sort of at least direction of themes. And so that validation, is going to come from either you've got some early signs of success, user adoption, but it can also be increasingly important to get validated from third parties, such as, established players. Are you going down a regulatory route? Can you get some stamp of kind of authority on you? Do you have revenue growth? And in terms of the more technical plays, that validation often comes from the developer community itself, the technical conferences where they're speaking, various recommendations and trusted from CTOs. So, there's all sorts of things. I mean, none of this is particularly new. I would call it good diligence, which you should normally do anyway. But I do think the lens has perhaps shifted a little bit more to the addressing the unpredictability, the validation side, and, the path to coming out of this downturn.
Got it. Yeah. I mean, all very, very important advice. I kind of recall a moment when, the tide was turning, when we were going from, tailwinds of the bull run towards the downturn, I guess, or the crypto winter. And it was only beginning.
Which one?
This one, the most recent one, right? So after FTX, it was quite abrupt.
But before that, you had Luna, you had Celsius, you had like
it was quite, but the FTX just felt like this massive blow to confidence towards the industry. Enough. And I remember kind of observing some of the memes that were kind of circulating in the web, right? When and there was one that caught my attention when it was basically showing a picture of due diligence by a VC during the bull run, which was a child in front of like a little, a computer screen for children, a toy basically. And then right now, what is happening right now is this guy sitting almost like in a mission control room, of the CIA with 17 screens, right? And this is, DD now versus DD then. How do you? I mean, it to me it was quite telling as well, and quite accurate. In the, at least based on my own experiences or if you have public fundraising experiences. How do you relate to that? Like, has due diligence really, gotten so much harder?
Yeah, I know where you're going, and the reality is that the best execution is somewhere in the middle of that, right? Because neither end of those spectrums are really either sustainable or good for all parties. The end of the spectrum that is almost FOMO, it can only end badly in most cases. It is sort of there's always going to be an element of there in hugely competitive markets and competitive deals. So I mean, at the end of the day, VCs operate on a portfolio model, and you can be excused for not wanting to miss out on something that could be like the big returner in your portfolio. But like in an ideal way, you've built up your diligence over time, so you're not making that kind of judgment on that immediate point, but you have done preparation work, so you understand what the key themes are. You've probably been following 5 companies. And so when that point happens that there's a deal to be done, you can be more aggressive in terms of speed. That's in an ideal world, right? And then on the flip side, the other end of the spectrum with the 20 screen cartoon, Like the reality is that, I mean, that's only because at the end of the day, the deals are getting slower to be done at the moment. And, that is mostly because VC deals at least at earlier stages, when I say early, it's before private equity, are syndicated deals. And so, you may actually have a lead, but the syndicate can still take a while. And during that period of time, because if there's a general slowdown on conservatives' deployment, it takes a while to build a syndicate. And so during that time, there's literally that time to do that research that you perhaps weren't doing before. So the ideal is somewhere in the middle, right? I definitely relate to both ends of those spectrums.
What do you guys? Yeah, Kevin, go.
Maybe I was going to say, like, at the same time period, there was, I guess, a bit the jokes about, in this case, Sequoia and their investment in FTX. It's like, no due diligence, look at them, such a bad call. But then there was also the email that they sent, like, yeah, we wrote that off, but here's the performance of all our other funds, and don't worry, we're fine. And the reality, I guess, is that if these guys were not going as fast as they were doing, and therefore having to cut some corners in DD, they would not have been able to do the other 19 investment that went super well, whereas that one blew up. So I guess it just depends a bit on...
Before I was saying, there is this element of, competitive dynamics, and in a portfolio, you need to make sure you're in that sort of winning deal. And you're right, like there's probably several deals that they adopted the same process for that are now performing super well. I mean, I think the FTX aspect was, maybe it was less about the diligence, and it was actually more about the governance after the investment that I would say, is more of the issue around that one. Because some things are super difficult. If fraud has been committed, I'm not too sure that even the best, 20 screen analysis and a 6-month diligence process would necessarily have cracked that.
If it's fraud, it's fraud. It's going to be hidden, right? I mean, you're going to need to hire a detective, really, and then make a full investigation to uncover it, because if people are trying to be fraudulent, they're going to be fraudulent, so to speak. And Anil, if I can ask a question, because you talked about unpredictability, but to some extent, isn't every single startup unpredictable because it's a hypothesis that is being proven or disproven, and that can happen at any stage, whether it's pre-seed, seed, or Series A, or Series B, or C?
Yeah, no, absolutely. There's a sort of dichotomy in my answer there, because our jobs are sort of based on investing into unpredictability, to your sort of articulated point there. But the diligence process and the process of managing to make the investment is all about trying to figure out as much or to reduce the kind of negative impact of unpredictability, right? The downside one. And secondly, also to reduce the information asymmetry problem, right? Which is often entrepreneurs forget that we're outsiders looking in to a large degree. We can do a lot of research, a lot of preparation, a lot of following, but we're outsiders looking in, and like it's the entrepreneur that decides what they tell us, what they put in the data room, what they reveal, which references they give, which partners they introduce us to. There is definitely an information asymmetry, and so it's just purely, I use the word unpredictability in a more broader sense, not in the sense of the fact that every option, which a startup is volatile by its nature, and that's how, options are priced. But unpredictability by, trying to reduce the things that we don't know, or trying to, gain some insights into what we don't know that we know that other people know, right? That's the key thing. It's what other people know, whether it's experts, whether it's you, whether it's other VCs, reducing that information gap is the unpredictability factor that I was more referring to.
Maybe to react on something you said, I think the part on information asymmetry is very interesting as well, because from our raise last year, I think a big chunk of what made it possible too is the fact that we knew our investors very well. Be it Ripple, Middle Game, Six, we've known them, like they knew Keyrock very well, which means that by definition, there is less information asymmetry, and therefore there is less dependency on the overall climate. Because, if the climate is great and you don't know much, you're going to tend to be optimistic and go for it. But if you don't know much and the climate is very bad, you're going to be very scared and not going to invest. So
let me interject there, because I think, there's also a flip side of that. I 90% agree with you. But, there is also the danger that they know you too well, right? And so, well, maybe it's not just complacency, but their expectations, being insiders, may not be aligned 100%. And then when they look at the shiny new thing outside, and the information asymmetry on that reveals that that is performing somewhat better than they thought you should have been, and oh dear, what's going on, right? So they may know too much, even though they only have information asymmetry issues on that other one. They have no information asymmetries for you. It may just be it may backfire. But like your point is generally correct. It's also very timely, and probably we'll come into this a bit later, but as we look forward. But like, I think the next 6 months are going to be extremely telling for those that are not in a position to have raised. There's we're getting to the end of a lot of runways, and we're still in a sort of tough market. And so, flat rounds, if you can get away with it, or bridges are the kind of talk of the day, because many entrepreneurs have tried to go out at higher valuations and maybe shot themselves a bit in the foot. But so now we're into the area where relying on your existing investors is one of the better strategies right now. So I think that is a very timely comment as well.
No, for sure. Thank you. It's fascinating conversation. I think definitely I would agree that you gotta develop a relationship with your investors. To what extent does that relationship impact investment decisions? Now and in the future, there's a question mark there. I wouldn't drive a direct correlation of at least for the position that Fiat Republic is in, between the existing or incumbent investors or investors that I have known for quite a while, that impacting the investment decision in a big way, to continue to invest in Fiat Republic. I think it also depends on the stages, I would say, when you go from early to later stage, and then the validation that you're demonstrating. But for sure, I would agree that you need to build those relationships, and the warmer the better, because the troubles are always going to come, no matter how much you plan for. There's always going to be some trouble along the way.
Yeah. But like, even if they are just doing a pro rata, that is a symbolic statement of support, which externals look at carefully. So I don't underestimate. I'm not talking about your insider stepping up and leading a round. That's also dangerous, right? Because the pricing is very difficult as an insider to do. But like doing pro ratas, or like even super pro ratas, those kind of symbolic moves are significant for externals. And as I said, bridges, just to buy you more time to hit some metrics, so that you can be ready for the next price round. Those are relationships you only get if you nurture them as insiders and you've been transparent. So they're not easy to come by. But I don't underestimate the value of your insiders. For them, it's also, if you're half pregnant, right? You have a difficult decision to make, which is which direction do you take with the baby? Knowing that if you don't add more nutrition in, the bad thing can happen. So it's every VC says that we should look at a follow-on as a new deal to be properly assessed. It's a deployment of capital. Theoretically, they're 100%, but emotionally, I can tell you that is not necessarily easy.
I was going to say personal is personal and business is business. So even if you have good relationship with an investor, the investor still needs to, on the business side, keep it professional and do the necessary due diligence before investing.
For sure. Yeah.
I mean, it's also validation for us as startups, right? If our current investors say, "Hey, we want to reinvest," they redo a due diligence and validate. That means that's a green light for us internally.
Yeah, I agree. Cool, guys. Let's change gears a little bit. So we've touched on, what is possible in troubled times, right? Are large raises still possible? Obviously, Kevin is is the proof here, or one of the proofs that they are. But like wider in the market, like if you look at other crypto, especially Web3 and crypto companies, are there any other examples of large raises, and what is the sort of the formula, or the formula, the secret sauce of doing a large raise in a market that is really tough? An open question, so anyone can take it.
I mean, I'll give it a first crack more generically, but clearly we're lucky to be here with Kevin, who's successfully done that. If you look at more recent activity, because I do think that Q1 is probably the worst, even though the crisis started, to be fair, and I can talk, Fabric had a pipeline that we were still executing on from earlier in the summer. So like the deals are not only delayed from a perspective of when they're executed on versus the current market time. If you're finishing off the legals or something like that, you may still have a month left of diligence. But then also they're announced a little later too. So it's really hard to gauge. But my sense is that Q1 is probably the bottom since the 2020 downturn in the crypto markets. And we've had a quarter-on-quarter decline in activity. You mentioned some January figures, but I think Q1 in general has been the lowest for a long time. And of course, large raises are so much harder, to do. The later you are, the higher correlation you are with the public markets, and of course the larger tickets, which is contrary to cash preservation, which is going on in uncertain times. But large fundraisings have happened in the past, in downturns in the past. In our industry, we've had multiple ups and downturns. I can't relate to say whether one is worse than the other, but Coinbase raised in 2013 and Ripple raised in 2015. Interestingly, these were big, chunky, double-digit raises. They're examples that are important because, what do they have in common? Or they are sort of trustworthy propositions, right? Coinbase at the time, that focused on regulation and security. Ripple had all of these validation points from their enterprise financial services customers. So I think, those are interesting themes as we look now in the more recent time. And my belief, it's themes in and around security, compliance, efficiency, scaling, those type of propositions that are actually doing pretty well. So layer 2 is obviously a very, very big topic at the moment. We've got Bitcoin scaling platform, Blockstream did 125 billion. You got Scroll with a zero knowledge EVM, raised 50, Risk Zero, a zero knowledge virtual machine, raised a decent chunk. Other themes are like custody and security and privacy. Again, all sort of that relate to not only pain points today, but
it's almost like it's if you're saying if there's fear, then that's what you're kind of saying. If there's fear, those kind of propositions that address that fear,
it's back to my uncertainty point right in the beginning, right? So if you look at custody, security, privacy, like Ledger, one of our portfolio companies raised a large round. There was Taurus that raised as well. Eigenlayer raised in Eigenlayer restake. So basically, it's staking security in a way. Aztec raised in the privacy space, and Chaos Labs raised in security monitoring. So just some examples, but those themes go prevalent throughout, and I would put Keyrock in the same kind of category. So I hope that's my answer.
Yeah, no, it's good. It's good. I can definitely, obviously, interested in Fiat Republic, where compliance first, regulatory heavy, has increased actually over that time frame. So I can validate that. Although we are early stage, and what I wanted to also touch on is I heard from one of the GPs, actually MPs, so managing partners of a big reputable fund, in the last month or so, growth is dead. Early stage, right? Seed is where efforts are going, or the attractiveness is still there, and the promise is still there. Would you agree with that, Michael?
I'm a strong believer that a lot of new projects are being built right now, and we're going to see a lot of cool new projects, let's say, be born today, and we're going to see them develop all the way through in 2024. So I'm a strong believer in that. But is growth dead? I think definitely not, because that also ultimately depends on traction, regulation, volumes, and how unique the product is and what problem you're solving, right? And how you've also adapted to the current situation, the current market conditions, and ultimately how you will survive these conditions.
Yeah.
I guess the further down the line you look, the higher the probability that one of these companies has raised at a stupid valuation in the last 2 years bull market, and therefore will be harder to be raising now. So to some extent, it makes sense that the activity is a bit less strong on later stages, whereas on very early stage you start from a blank sheet, so to speak. So it's a different dynamic when we go to a very bull to a very bear market.
Yeah. Anil?
Yeah, we see that there's a significant amount of interest in our early stage venture fund, and even earlier in terms of incubation and acceleration. Company spot on. In downturns, people hunker down in front of their computers, developers get going and do the work. So there's lots of flowers being bloomed at the moment. Each one of them doesn't have the baggage that Kevin referred to around, a prior raise at this valuation that they somehow have to be, measured against in the past. And is that a negative signal because it's a down round, et cetera, even though it may not be that signal, but it's perceived that way. So that baggage is not there. They obviously didn't have and don't have metrics in the same way that can be sort of monitored and assessed. Even though it's a shame that the broader market is down, the question should be, are you down further relative to the broader market? But that's often a really hard comparison to make. Right? What is the comp for you, and et cetera, so that startups, early stage startups, don't have that. And then it appeals to this sort of optionality nature that we also discussed earlier, which is, it could be one of the new things. Now, I do tend to think that these bets at early stage are not blind. For us in particular, we're very infrastructure focused at the very early stages, right? So we are trying to play into some big tailwind trends, whether it's the ones we discussed before, like layer 2 scaling and things like that may come to fruition over a number of years, but you need to make those bets today with enough runway to see them out, and you need to have a very, very strong technical team, because it's really much more about the team, the uniqueness of the tech approach, and then the ultimate market that you may be going for.
Yeah, no, for sure. I completely agree. Okay, so just wanted to go into what sort of lessons, tips and advice, specific one, maybe not, slightly less high level, more specific, that we can provide, based on our own experiences to companies that are trying to raise right now. Kevin, what mistakes, if any, obviously, don't have to disclose anything confidential, but what mistakes would you caution people against, and what were the sort of some of the biggest lessons in that process for you?
So I think for me, and it's maybe not directly related to this specific race, but more general, we raised a couple of times over the last 5 years, and I think that for me one of the biggest lesson is the need to really carefully understand which investors you should be speaking to, and which ones are a waste of time just because of who you are as a company. And that's something that took some time, also in our earlier stage to figure out, because Keyrock, we're a market maker, delta neutral trading company, lots of tech, but also trading. So like, where do I fit? And then you start talking with lots of investors that are purely SaaS focused, and that makes no sense because we're not a SaaS. And I think that there's kind of a willingness when you get started. So okay, let's fill that pipeline. Let's get as many potential as investors as possible in there, because eventually I'll get something. And of course, there is some merit to that. But I personally believe that it actually makes sense to be a lot more to take more time in pinpointing which investors actually correspond to what you're doing and what you're building. And so I think doing that, in my perspective, is valuable no matter the cycle, but even more so if the cycle is if the environment is a bit tough, if there's less time, if you have more pressure on your runway. It sounds a bit counterintuitive to say spend more time at the beginning if you have less time to do the round. The reality is that if you talk to a lot of people where there's a 95% chance when you start that it's not going to go anywhere, you're going to spend 3 calls explaining what you do, and then they're going to say no anyway because it's too far from their core business. It's a massive waste of time. So I think that really pinpointing who to speak to, given who you are as a company, I think is extremely important.
I agree with that 100%, because we're on the brink. For example, Nebeus is on the brink of between crypto and TradFi. So for us, it's sometimes very difficult to pinpoint which investor to talk to. If we're talking to the pure crypto investors, they're looking for infrastructure. But us, we're kind of, let's say, the app that bridges crypto and traditional finance in a single, let's say, location. So we have interest from both crypto, but we have interest from both, also from traditional investors, traditional VCs, and sometimes the crypto investors only do token rounds, right? So we start talking to them, and in the second, let's say, conversation, they're like, "Oh no, we're all interested in token," and at that point, it's a waste of time. So yeah, I definitely agree with you, Kevin.
Yeah, and if I can add, absolutely super valuable insight. If I can add something, also. It's the time of the specialists, but the specialists are like in our spaces. Like, for example, Michael, you're in the same space, Web 2.5. We are in the same space, although in a different business model, more sort of B2B focused. And you talk to a crypto fund, they don't understand the banking or the TradFi part of what you're trying to propose. And you talk to the traditional ones, they don't understand anything about crypto, right? So who do you talk to? Who do you talk to? And how do you? And also, because my biggest lesson is investors, any investors, like specialists, generalists, they always want optionality. So they'll keep, taking up, your time, going, putting you through the process. If you open up multiple of those processes, you're just going to be dead at some point. It's really impossible to, for a founder or a small group of founders to kind of continue fundraising for prolonged periods of time in that sort of market. And to that point, Kevin's advice, where you really are strategic, you're selective, I 100% agree with this as well.
Well, it's also another.
Come to Fabric. There isn't a discussion.
I knew I was about to say it myself. I knew that was coming. You should talk to Fabric.
There's also something
plug-in somewhere.
Of course. Yeah.
There's also something I can point out. Like, we've talked to multiple investors who are fintech, right? Fintech investors, and but they haven't made a lot of crypto investments or none. And we've been talking to them, and at the end of, let's say, the fourth conversation, really, so like a long time passed, they say, "Oh, look, we made an internal discussion, and we're not ready for crypto."
I had exactly the same. Yeah. And as everything was sort of blowing up around us, Silvergate, Signature.
It was. A lot of traditional VC funds were actually reasonably far down the path of either hiring or setting up, the requisite back office that you need, custody, thinking about all of the things to manage tokens, accounting and taxation of them. And, I had several lunches with VCs saying, okay, so what do I need to do? And that just simply overnight disappeared. I think your instincts might have been correct that the broader interest in the space is there. and we've taken a big setback, and it will take some time to come back. But businesses that are, have a traditional models, whether it's traditional banking models or spanning the two worlds, such as in both your cases, all three of your cases, sorry, I think will help move that traditional VC, group forward. I mean, I come from that traditional VC. I used to run PayPal Ventures, so I recognize the journey they need to go on. And what they're averse to today are these sort of FOMO token, here today, gone tomorrow, no utility deals. I don't think they're averse to the opportunity of fundamental change, decentralization, improvements in efficiency, cutting out middlemen, all of the kind of positive things that resilience that we can, privacy we can get from on chain. I think they believe in that. They're looking for the right models that take them on that journey, whether that's SaaS, whether that's banking, whether that's connecting the dots between the two worlds. So you have to be optimistic, as I'm sure you are. And the problem is you've just timed a really bad environment, which is more why I do think that many companies will be seeking bridges to see them through the next sort of 6 months, and which is why that you can use that time to really identify, looking forward, who would be the perfect fit for you for your next round. And you almost have to be planning that now, right? Unless it's your final round before IPO. But I think, you have to know who is going to be the lead and the syndicate for your next round. And you have to start planning that for like coming out of your current round. You have to build those relationships. We spoke about relationships before. They don't want to assess you in the middle of a downturn over a 2-month period. They want to assess you over a year period, see the ups and downs and see how you cope. So this is something that one has to invest in well ahead. If you truly don't know your target audience when you need the money, I think you might as well face the music that you either adopt this sort of, let's go to everyone and like hope for the best, and I'll just carve out 99% of my time for the next 6 months and like hope that my co-founders can run the business and it won't collapse. You either take that approach or you really have to go to your existing investors and buy the time to do it properly. So but I do want to also highlight one thing that Kevin said is very early on, and I will 100% agree, and I've seen it both in my portfolio and elsewhere, but it's the hardest thing for an entrepreneur to recognize that, one day their business is valued this and one day their business is not, right? I mean, it just doesn't make sense. What do you mean? But the same way that the business was probably not valued up here, it's probably not valued down here, right? And so being stubborn around not recognizing where the shift in market is and going out with an unrealistic, non-market standard pricing, it just will lead to one thing. The VC rumor mill is so small and they all talk to each other. I hate it. But basically you'll be branded as a failed round. And then people will say, okay, I've got 101 things on my list that could go wrong about this company. And there's information asymmetries, as we spoke about before. So I don't really know. And now we've got this failed round. Was it really a failed round? Do I really know if it was a failed round? Is it a rumor? Is it truth? I don't know, but it's information asymmetry. It's going to be another hair on the deal. And sometimes it's just a deal killer. And it's really unfortunate.
But isn't there a risk to the entrepreneur, to the startup, of, let's say, going and lowering their valuation too low, like below what you're actually valued? So basically you're giving away too much equity.
What are you actually valued at, right? So that, you are valued at what the supply and demand balances out at, right? There's no better way to say it. I mean, we're not a liquid stock market, but, there is a sufficient liquidity here to understand that the multiples one day at 100x, don't suddenly become 10x, and the likelihood it's somewhere in between. That's number one. And number two is you're on this for the long haul. So you have to be realizing that the dilution you take, if you can generally keep your company alive and build a bigger pie, is worth that pain. And so, of course you don't go out and say, well, just name your price, I'll give you my business. Any self-respecting VC is going to want to know there's sufficient equity for the founders, there's a sufficient ESOP pool, and there's sufficient runway. So like they're always going to have these inherent balances when they put a valuation down on you, because they cannot, and they won't dilute you. And if there's a VC that dilutes you way too much too early, then there's an issue around whether it's the right partner. So I think they have these self-correcting mechanisms when they look at valuation. But your first would simply be to say, look, we understand it's we should have raised more. Had we known at the time we were raising our last round, let's call it 6-9 months ago, before the downturn, we would have realized that our metrics would need another 6, 9, 12 months time. So therefore we would have needed to raise 6, 9, 12 months more runway. So we would have wanted to raise a slightly larger round on the last one. So I'm going to want to extend the terms on my round. Maybe you adjust them slightly up because of, there may have been some dynamics and you have to protect the dilution and option pool, as I said before. But nonetheless, that's the kind of starting point of your thinking, that ultimately what's happened is people need more runway through the down markets. And so it's really an extension of what you should have raised before, had you known the future.
Cool. All right, guys. So just like I have to do this, the billion-dollar question for the end. What's next in crypto, right? On the, let's say, market front, the VC, sentiments, what's going to happen like towards the end of this year, and then next year? Like, give me your sort of your personal predictions, and also how do they impact, your businesses and obviously in Anil's case, your fund. Kevin, if you could start.
Sure. Of course, I'm going to be very, very biased in my answer, I guess. But I wouldn't, honestly, I don't make prediction on I don't have a prediction for what's going to happen this year. Like for me, if you look at the trend, I'm in trading, right? So you see the price, it goes like this, right? It's you need to cancel out the noise and see, what's the trend. And I think that when we look at the market itself, that's really what I focus on. So for me, what's next is still the same. I think that eventually every single piece of value will be fully digital on a decentralized ledger technology. And that's going to be, for me, equity, fixed income, bonds, identity, gaming items, mortgages, everything. Like this is the infrastructure of all exchange of values down the line. I think and changes nothing. Like, all the blew up last year, everything, regulatory uncertainty, of course, there are friction, it's going up, it's going down, it's going up, it's going down, but eventually it just makes so much more economical sense to exchange value through a digital token than through the traditional infrastructure, that I think eventually everything is going to be on it. And so I think the trend that we're seeing now around, real world assets, so to speak, because I put brackets here because I think, digital world is as real as the analog one, is just different. But everything, all the trends that we see there, the declaration of, Larry Fink, of what is being done by Bank of America, all those studies, so and so trillions coming on chain. I think it's there. It's back in 2017 when we started, it's like it was already talked about. It's like it's coming, but it's still coming. It's not there yet, but it's clearly accelerated. So I think that for me, this is next. It's going to continue to be a gradual transfer from a legacy system to this new system, and that is something that is going to continue. So I cannot really make a bet on 23 because that's not the time horizon that I personally optimize for again. So, but I think that the trend in there is extremely clear, and just continues to accelerate, definitely.
Awesome. Thank you, Kevin. Michael?
So I think gradually the markets will come back, right? This is for economic reasons. This is for the reason of Bitcoin halving happening in 2024. So markets are going to come back slowly, unless we have another, let's say, colossal, crazy catastrophe that happens in the markets and everything drops. Knock on wood. I already mentioned new players going into the market. So we're going to see a lot of that. New players, new exciting projects coming in. And for us, from a business perspective, we see lending and crypto-backed lending coming back, especially on the CeFi side. Again, the biggest use case of crypto-backed lending has always been investment diversification. So people use their cryptocurrencies to get loans, to buy more cryptocurrencies, or invest in other assets. And we right now on Nebeus see users coming back who have not gotten loans before, let's say, Terra Luna crash. They're coming back and they're starting to slowly get loans again. So I forecast that during this year and towards 2024, we're going to have a lot more crypto-backed lending, new players, market's going to come back, and hopefully that will lead to a bull run again, unless another FTX situation.
Okay, interesting. What do you guys think about Mica? I'm kind of going to roll back to both of you. Yeah, is that a good signal? Because it's like the timeline looks like it's mid next year for rollout, and then end of next year for like forcible implementation. What do you guys think that's going to mean?
We're regulation first as Nebeus, so I mean we're ready to apply as soon as applications are open, as soon as it's available. I mean we're already registered with the Bank of Spain as a cryptocurrency custodian and VASP. So Mica for us is simply the next step.
And I think it's amazing. No, so sorry. Finish, please. Yeah, I think it's great news. You know, it's there's lots of things that are wrong with Mica. Lots of things that are missing, but it's the same thing. You know, AMLD5, AMLD6. I'm sure you know AMLD6 is not out yet. We're already talking about 7. There's going to be Mica 1, 2, 3, 4, 5. Right? It's going to continuously be iterated on and be improved, and hopefully, you know, cover more things better and address some of the shortcomings in the current in its current version. But it gives a framework. It's a foot in the door. It's a start, and there's something to iterate on. And so, I mean, of course, it's kind of an easy comparison to draw. If you look at how things are in another very big market in the US, I think that, you know, Mica is a tremendous opportunity for Europe because it's far from perfect. There's lots of things to improve, sure, but it's a starting point that has the merit of being clear and putting a process in place to improve and move forward. So I think all in all, it's definitely a tremendous opportunity for Europe.
I'm glad you said that. Yeah, I 1,000% agree. Europe has a generational opportunity right now in this specific space, and we just need to do whatever we can to use it to the fullest in whichever EU country you're based. You gotta double down because it's an amazing opportunity. Anil?
Yeah, well, both on Mica and on the future. So like I briefly on Mica because we have better experts in the room here, but yeah, it sort of really addresses my first point, which is reduction of uncertainty. Whether it's right or wrong, it's like, it almost doesn't matter. You have some rules. I think Kevin summarized that really well. Now there's a cost to comply, and we know that from whether it's a traditional fintech business or not. You know, there's a time, cost, skill to go through these things to continually be compliant. It's the rules of the game. But if you are, then I think if you can afford to pay those costs and have the access to that expertise, then the payoff will be bigger in terms of trust and, you know, especially areas around addressing the more mass market as opposed to necessarily the degens. So I'm, for those reasons, in favor. Also echo your Europe first thought. We're a little biased. We, you know, have European Investment Fund as one of our key LPs, investors in our fund. So I'm not, on one hand, I have to say that, but on the other hand, I also believe it. So I've seen many US entrepreneurs recently rethink where they set up. So no doubt that it will benefit us while the US is still playing politics in their regulatory setup. And you know, maybe that's a harbinger for improved market conditions going forward. Certainly for some companies that are on the kind of sort of centralized edge of the world, or 2.5, if you like, they should benefit from that certainty, and will get similar certainty coming for tax as well. So I think that may benefit fundraising for companies in that area for sure. But more generally about fundraising and the future, I think there's 2 points to make. One is that ultimately our job is to invest, right? So there's only so long that one can hold back. It's almost somewhat similar to what Michael was saying about some of his customers. How they need to do what they need to do with their crypto in order to continue their business and their livelihood. So you can take a pause for 6 months, but like at some point you need to come back, right? I mean, that's what I'm paid to do as well. But more importantly, valuations have adjusted down, and like history has shown that some of the best businesses are built in down markets. Where people are more self-reflective on how they spend money. I had 1 or 2 cases of companies during the bull run that, went from 20, 30 people to 130 people in 6 months. It's just nuts, right? But everyone has got carried away with it, but like that doesn't survive and sustain. So I'm optimistic, and then I have evidence points to back that up too, right? Because like there was so much what we call dry powder raised in our industry, which is effectively the capital that's raised from our investors, limited partners, such as the European Investment Fund that I mentioned before, but not yet deployed. So it's dry, so to speak, in funds. I mean, we are in our fund only 50% through, and yes, we have to reserve for follow-ons, which there'll be more of, as I mentioned before, in the next 6 months. But basically, a lot of funds are ready to deploy, right? And I think the number that was raised, and this is a more generic number versus a Web3, but like 826 billion was raised, according to Goldman Sachs, in the last few years. I mean, 4% of venture and late stage investing. I mean, it's like nuts. So what are they going to do with that money? Some may return it. That may be deemed a better return if they generally feel they can't, but to a large degree, it's their livelihood. So I don't think they'll be doing that easily. So they'll be wanting to invest in companies like you guys.
Is that something that happens, giving it back?
It actually has happened and does happen.
Oh yeah, okay, interesting.
So the judgment call, and like it's rare to see that at the venture end of the spectrum, because returns obviously can be so significant. But if you're sitting at a later stage fund and your benchmarks are closer to what is an IRR type model, then you're measuring yourself against, like, I don't know, money market or bond or whatever, and then you go, okay, so am I going to be outperforming that given the commensurate risk? To a large degree, it may make sense just to hand it back. You maintain the relationship with the LP. They do support you, and for the next fund, they look at that and say, this is part of our long-term relationship building between them as institutional investors and those funds. So it's investing into the future, I guess, and they probably can afford to do it. They might be on their fund number 4, number 5, or whatever, so they have plenty of management fee to sustain themselves as a private equity fund or something like that. But yeah, it happens.
I like what you just said. Invest into the future.
It also happens, by the way, some companies do that too.
Yeah, I was gonna say invest into the future as well for the companies, but also for the investors. It does sound a bit more optimistic, and I think the winds are changing a little bit, and I can feel it. There are some symptoms of a recovery coming, but fingers crossed for that. And in the meantime, thank you so much, gentlemen. Kevin, Anil, Michael, you are my crypto legends, genuinely. So it was a pleasure to have you on the show. To our audience, if you want to stay updated for more legendary tales, smash the subscribe button, leave a comment for what you'd like to see, what you'd like us to cover, and stay tuned as we bring those most empowering stories from crypto legends of Web3. Thank you very much.